Our outlook for 2020 is that we think growth is going to edge somewhat higher versus 2019 and push risk assets like equities and credit somewhat higher across the year as well. The three themes of the 2020 outlook are policy pause, growth edges higher, and rethinking resilience. Policy was really the story of 2019, both in terms of the frictions that we saw between the US and China on trade, but also in terms of the really significant pivot from the Fed and other central banks. In 2020, we see both of those policy changes as really being in the rearview mirror. As the Fed articulated at their December meeting, the barriers to cutting rates further are pretty high. And on the trade policy side, we think that on balance, the incentives are very strong for both the US and China to want to push the pause button. We're now looking forward into 2020 and seeing growth edging higher. With trade tensions on pause, several of the economic sectors that were beaten down in 2019, global trade, manufacturing, business investment, we expect those to be at the leading edge of the modest recovery. We think it's also important in this moment to rethink resilience in light of some changes in the market and economic environment. First, for investors outside the United States, especially in Europe and Japan, interest rates are increasingly reaching the lower bound. Secondly, in the United States, while rates are high enough that treasuries can still be an important cushion, it's important also to think about the other types of risks. One that we're in particular thinking about is the risk that inflation could edge higher in the years ahead. And third, investors need to think through what it means to build sustainable portfolios. That's true with respect to climate as well as environmental, social, and governance issues more broadly. The bottom line for portfolios is that we think in 2020, a modest tilt into risk assets like global stocks and credit will be rewarded. Emerging market debt and high yield debt, Japanese equities and emerging market equities. We've pulled back a little bit with respect to our view on the US, back to neutral. And we're very cautious on global bonds outside of the United States, especially in Europe and Japan.